Um, Good morning, everyone. My name's James Kipping, tax partner at MHA. Thankfully, you won't have to listen to me for very long this morning. I'm just here to introduce our guest speaker, Professor Joe Nellis, for this morning's economic update. Many of you will know Joe from his previous updates, but for those of you that don't, Joe is professor at a professor of global economics at Cranfield School of Management. It's probably an understatement to say that the post-COVID, post-Brexit world has brought its fair share of economic turbulence and challenges. Add to that a war in Ukraine. These are certainly challenging times. We're delighted to have Joe presenting once again, and he'll be sharing his views on the impact of these events and the future economic outlook, both in the UK and globally. The format today is about an hour of presentation with at least 15 minutes for Q&A at the end. I think we're scheduled to finish at 10:30. And Joe has just told me that we'll have plenty of time for questions. In terms of questions, please don't try and use the chat. Please instead use the Q&A function. My screen actually has two Q&A buttons. We're not sure why. Use either of them. I will monitor both and we will cover as many of the questions as possible at the end. And finally, slides will be available after the event. And I believe they'll be sent out to you, or you'll get a link to access them. So without further ado, I'll hand you over to Joe.
Thank you, James, and good morning, everybody. It's a real pleasure to be here, albeit online, but this is the new world that we live in. I'm not going to spend too much time in terms of prelims. I'm going to go straight into this and start sharing my screen. And just give me a few moments to do that, and you should see the first slide coming up now. Unless James tells me otherwise, I'll assume you can see the slides. So, thank you, James. So the title is UK and Global Economic Update. I'm going to start briefly with the global economy, and you'll not be surprised that a lot of the information is fast moving, and I've tried to keep up to date as much as possible. I was even editing last night and this morning because things are changing very, very quickly. But in terms of the global economy, the latest global picture we have is from the IMF in July. And these will change slightly in the next couple of weeks, but not dramatically. And just to summarize the view of the global economy, there has been a significant slowdown. Now, on the left-hand side, you'll see in 2021, the global economy grew by 6.1%. Of course, that was exceptional. That was during after the big drop in 2020 because of COVID. We then had the V-shaped recovery. And so it's inevitable that the global economy would slow down, but it is slowing down faster than normal. The global economy normally grows between 4 and 4.5% a year, if you take a long-term trend. So by 2023, the IMF at the moment is predicting growth of less than 3%. But still, it's positive. And let's look at the bright side of life rather than all the negatives. However, in the middle of this graph, the advanced economies have got a particular problem. Growth is going to slow down sharply. It already is happening. And this is primarily due to the crisis in Ukraine and the war with Russia. And of course, we all know the consequence of that for energy and food prices. I will come back to that, of course. On the right-hand side, the emerging markets and developing economies, again, they've also slowed down, although growth of 3.6 and 3.9%, while it seems very, very good on the face of it, for the emerging market and developing economies, this is actually not great news. They would normally expect to grow at 5 or 6% over the last 15 or 20 years because they've got a huge amount of spare capacity and they need to grow quick as well. But that's the current situation. In terms of breaking down into regions, and again, all of us will be aware of much of this. The US is looking at a sharp slowdown. You'll see in 2023, the IMF predicts growth of only 1%, but not a recession, interestingly. The US is doing okay, given the state of the global economy. And the dollar, of course, is incredibly strong at the moment. I will come back to that towards the end of this presentation. The euro area, likewise, slowing down sharply, and along with Latin America and the Caribbean, and et cetera, et cetera. But I want to focus on the right-hand bit. The emerging and developing Asia, the right-hand projections are dominated by China. Now, China has had a significant slowdown, but even in the worst depths of the global economy as it is today, China is still growing between 3 and 4% and will pick up next year. So it's interesting that what we're seeing, I think, is a rebalancing of the world economy. And I think this will continue for several years, perhaps for a very long time. And that brings me to a topic that I mentioned in the last presentation that I gave. It's what I refer to as the changing spheres of influence. And I think events over the last 6 to 9 months have really reinforced the changes that are already emerging in the global economy in terms of the balance of power. You may remember that I highlighted last time the obvious importance of the US as a sphere of influence, and the countries that are aligned with the USA, particularly a number of Latin American countries, and perhaps the UK to some extent, but I don't want to exaggerate that. But of course, what we've seen during the Trump years, and to some extent during the Biden years, and during more recent times, is the US influence has come under, I won't say threat, but it's diminished because of what's happening elsewhere in the world. The EU absolutely is a major sphere of influence, and I don't want to focus on this, but Brexit has impacted that negatively. And of course, the EU itself has got some problems, shall we say, between the north and southern countries, the economic imbalance that has been happening for some years. But the big point, of course, is China and Russia. And I noticed that the two countries are going to meet this today or tomorrow. And you know, they're obviously forging, they have forged an alliance, and I think the alliance will continue to be forged, not necessarily in a military way, but in an economic context. Russia will be looking to China for a lot of economic support in the coming months and years. And of course, China is spreading its influence around the world at an even faster rate than had already been taking place. And so what I think we're seeing across the world today is a significant change in the balance of power. Essentially, USA and Europe, that balance of power, as it were, being handed over to some extent to China, and Russia, question mark. But I think this has implications much longer term for trade relationships. Who trades with who and on what terms? And of course, the UK, in the midst of all of this, is very keen, very enthusiastic to agree a number of major trading deals around the world. But as I said, the question will be on what terms. And I'm sure we'll come back to that later. Now, that's just context. So in summary, world economy has slowed down, but not everywhere. Some countries are going to have a tough time for the next couple of years. But let's not forget, there will be, as it were, life after this crisis. And as soon as this crisis ends, I think we'll see a significant upturn in the world economy. When that will be is beyond my pay grade. But that brings me then to the main point of today's presentation, an update on the UK economy. As I said earlier, I've tried really hard to get everything as up to date as possible, even up to last night and this morning. And you'll see some of this coming through. In summary, a bit like I talked about the world economy, 2021 saw an incredible rebound in the UK, which was not surprising. It was absolutely expected. Growth last year is now officially put at 7.5%, but that was after a fall of 9.4% in 2020. So we went down sharply and then we bounced up, not the whole way in 2021, but it was the fastest growth on record since the Second World War. And we're now just above the pre-pandemic situation. So sadly, we've had 2 years of lost growth. That's gone. We're now back to where we were before the pandemic. But of course, it does mean we've lost, a lot of opportunities. The government has lost tax revenue. A lot of investment that could have happened didn't happen. But that's history. We now look to the future, of course. And the future, and by the way, I put this word in quotation marks because it's not my word. It's a word you will find on the BBC website. A lot of economists have used this word. We now face a bleak outlook for the next few years, but I do want to qualify that heavily. So much depends on what's happening in Ukraine and how long the crisis will continue. Let's just all hope and pray that it ends as soon as possible. Peacefully, of course, because I think then we will see a significant bounce back again, not of the same scale as post-COVID, but there will be a renewed optimism. So that's the context. And if I said anything different from what you see on the screen, I think my credibility would go out the window. We know we've got some tough years ahead, but there will be opportunities as well as challenges. And I'm going to finish the presentation on exactly those points, the challenges and the opportunities. In terms of UK growth, I think this is a really helpful graph produced by the ONS and the Office for Budget Responsibility. So this is the official data for the UK. Whether it's perfectly accurate or not, I'm very confident that they do a great job giving us the best possible data. And I think what's really interesting about it is the 3 decades that are mapped out here, just to talk about the trends. Back in the 98 to 2007, before the financial crises, our average rate of growth was estimated at 2.7%. Just to take and averages are obviously a very simple statistic, but it gives you an idea of what have we achieved on a sustainable basis. And 2.7% at that time is pretty good for the UK. It's a solid performance. But then we come to the post-financial crises decade, and our average rate of growth has only been 2% during that period, with some ups and downs. But now the forecast for the next decade, at least up until 2026, and this is a forecast officially from the Office for Budget Responsibility, they're predicting that our growth will be 1.8%. Now, if we achieve 1.8% as an average, I think we'll all be celebrating. And I hope these figures are correct. My own personal view is that it could be somewhat less than that. I think we've got a way to go yet before the major investments that have been announced in the last couple of years, before they start to have an impact. I mean, high-speed rail is going to take many, many years to impact our transport system. Energy and nuclear power plants are going to take many, many years. The apprenticeship levy and the funding of skills development, again, this will take some time to feed through to the economy. But we are building the basis for the future. And so, there are positive messages here as well. But I think this data speaks for itself. And let me just pause for a moment. The fact is we are an advanced, mature economy, and it's almost inevitable that our long-term rate of growth is going to slow down to something that's more sustainable. We're not an emerging market. We don't have huge spare capacity. We haven't got, spare labor, as you well know. And so to keep on growing, we have to keep on investing in technology and skills and infrastructure. And we haven't done enough of this for many years, but now we're doing it. I've often used the phrase, and I'll use it here today, investment is the engine of growth. Every company here today knows the importance of that. You've got to keep investing. And that's the basis for the future, which I will come back to, by the way. In terms of other points about the economy, well, let's celebrate the fact that just a day or two ago, the latest unemployment figures came out, and they show that unemployment fell even further from the previous quarter to 3.6%. This is once again the lowest that I've ever known in my professional career. It takes us below the pre-pandemic level. So not just back to it, but actually lower than the pre-pandemic, which is incredible, really. But I'm an economist, so I've got to give you the but side to this. There are labour shortages, as I'm sure many of us are aware of, in many sectors. And this is now creating a number of challenges. First of all, job vacancies are almost at a record high, not quite, but almost. And they fell back a little bit in the last month, according to the figures just out 2 days ago. The employment rate, which is the activity rate, is also still below its pre-pandemic level. Now, that's a rather strange bit of data. So 75.5% of the economically active population, people who are eligible and able to work, they're still below the pre-pandemic level. Now, why is that the case? Well, the fact is that, some people have left the labour force. Some people have left the country, by the way. Some people have taken early retirement. Some people have decided to go part-time. But the consequence of this is that we now have a limited capacity to satisfy any recovery that there may be in demand across the economy. So thinking ahead, when there is going to be a recovery of economic activity, the big question will be, do we have the capacity to satisfy that demand? And we are going to have some constraints. And the consequence of this is quite clear because we're seeing it now day in, day out. This is adding to inflationary pressures based on what economists call a wage spiral. As inflation has gone up, so wage demands have gone up. And wage demands are more likely to be met in the context of a shortage of labour supply, as you all know. And so there is a danger here that as we see recovery some way ahead, it will also stimulate more wage demands, which will reinforce the inflationary pressure. So we're not expecting inflation to come down significantly any day soon. I know it came down slightly yesterday, but that was only because of petrol prices. Again, I will discuss that in more detail later, I promise. So here's the latest figures for unemployment. And I just show this graph only to illustrate the point that unemployment is now the lowest, well, as you can see, going right back to the 1970s. Well, really since these records began, at least the official records began. So it really is a remarkable achievement. And if you look at the rise in unemployment during the pandemic, the rise was really much less than many economists, including myself, much less than we expected. But of course, that's because the furlough scheme was very, very successful in retaining people in jobs. So congratulations to the government for that. And we should all be grateful for what happened then in terms of government policy. I've brought together unemployment and job vacancies just for a shorter time period, because it was back to the point I made earlier. And you'll notice on the extreme right of this diagram that the number of job vacancies, the blue graph, is now just slightly above the number of people officially registered as unemployed. And this has never happened before. It's remarkable. It's been the case for the last few months, as you can see on the right-hand side here. So there is pressure now in terms of getting workers, employing people, because the number of vacancies is now just above the number of people registered as unemployed. So if you're having difficulty recruiting, that's not a surprise. We're all having the same difficulty because of the labour supply. But as I said earlier, there's going to be, I said, pressure on wages. And as you'll notice in this graph, on the red graph, you'll see that the rise in wage growth. Now, this only goes back to June because they come out these figures come out quarterly, these particular ones. And so we're waiting for the next quarter, which will come out in the next few weeks. But again, you'll see on the right-hand side, the wage growth beginning to grow. This figure shows 4.7% as an average, while inflation was 9.4%. Now, the point I made earlier is this. As the demand for labour increases, there is a shortage of labour supply, and therefore the workforce will have some pressure, some bargaining power to drive up those wages. The big question is, can we balance the books, as it were? Is wage growth going to be restrained? And is inflation going to come down? Those are the two things that we're all watching, I'm sure, very, very closely. But I want you to notice the wage growth line at the right-hand side is beginning to show a sharp upturn. and we'll talk about it again. But and just before I leave away from this point, of course, I did say average wage growth. It's not the same in the public sector and in the private sector. Public sector wages at the moment are rising at about 2%, 2 point something percent. In the private sector, it's more like 6 to 7%, excluding bonuses. So there's quite a big difference. And that's why we're seeing a number of strikes being held in the public sector at present, which is not a big surprise. It's what happens next, which is the big challenge for the country and for the government, of course. Excuse me. We've all heard of this levelling up agenda across the UK. And I think it's a really useful graph to show. The figures are for 2020. They don't do this very often. It's obviously quite a lot of research on the part of the ONS to collect these figures. But I think the picture is very clear. The top five areas there, you'll see London, South East Scotland, East of England, Northwest and Southwest. In terms of productivity, they're the most productive areas of the country. Let me define productivity. Productivity is measured by the ONS as the value of output per person per hour. Output per person per hour. If you think about it in very simple terms, if I employ you, what I pay you in terms of wages reflects the value of your output per hour. And so it's not surprising that with London and the Southeast in particular, having such high productivity relative to the median, clearly you tend to get higher wages, of course. Now, what's interesting is Scotland is very productive relative to the median down here in the middle of the country, which is quite surprising. I don't mean that in a negative way. East of England, I would expect that. And then the Northwest is productive. So Liverpool and Manchester should be very proud of themselves. But the problem arises at the bottom of this graph in terms of the levelling up agenda. Northern Ireland at the bottom, I will say no more. Wales, Yorkshire, Humberside, North East, East Midlands and West Midlands. So this is what the former Prime Minister referred to when he talked about the levelling up agenda. And it's going to take a very, very long time, of course, to achieve a total equality. That's not the intention. But I think there's a lot of scope here to do a lot more in parts of the country in terms of investment. Excuse me. Now, I mentioned the word investment, and I don't really want to focus on Brexit. That's gone. But there's an interesting piece of research was published by Bloomberg just recently, and they analysed the ONS data, and it is fascinating. And I say I don't want to focus on this. That would be a distraction from today's presentation. But if you look at the pink line, what they've done is they've used the data for business investment in the UK business investment, and they projected the line from 2010 up to 2016. And if this was assumed to be a trend, they estimated the trend, and if we assume the trend would have continued, then UK business investment would be somewhere around, you'll see there, about 80 billion by the beginning of this year. But in actual fact, business investment since we left the EU, or since we had the vote, has actually gone the opposite direction. And it's estimated that we're somewhere in the region of 31 billion less business investment in the UK than would have been the case if we had stayed in the EU. Now, as I say, this is not the purpose of today's presentation. The key point I want to make is this, and I'm going to repeat myself again. Investment is the engine of growth. The lack of investment is a problem for the future, and it must be the top priority for all of us, including the government, but also for businesses. We've got to focus on investment, and the government has to make investment more attractive for all of us. And when I say investment, of course, this is UK business investment, but I'm happy to take investment from overseas as well. So I'll come back to that at the very end. I think there are some good signs in that respect. But it's a remarkable graph. And remember, this is based on the official data. The black line is based on the official data. This is actual data. The pink line is simply a projection based on the previous decade. And so let's keep that in context. Now, and I updated these figures just last night. I could have checked them this morning, but I think they're going to be very, very similar. I thought I'd better mention government finances because there's a particular development taking place which has implications for all of us. I've shown you here, I've taken a screenshot of 10-year government bond yields as of yesterday, I say about 5 o'clock. And I think it speaks for itself. You can all quickly see what has happened. If you go back about a year ago, bond yields were 0.5, 0.4%. 10-year government bond yields were very, very, very low. But in the past 12 months, the yield on 10-year government bonds has shot up significantly. And it's now, as of yesterday, 3.2%. Now, let me just highlight this. 10-year government bond yields represent the benchmark for the cost of capital. It's the risk-free interest rate. Well, it's the risk-free return if you lend money to the government. But that represents the cost of borrowing to the government. So first point is government's cost of borrowing is going up. And the reason why it's happening is not difficult to explain. Bond yields represent the capital market's reflection of inflation expectations, and they do expect more inflation. So they're factoring in that they're expecting a higher yield to compensate for inflation, future inflation. It also reflects the capital market's perception of risk in lending to, well, the UK government. Now, the UK government is not going to default on this, but the state of the UK economy is the measure of risk. So we are heading into a slowdown. There will be a recession, but I think a mild recession. And the capital markets are factoring this into their pricing of bonds. Now, but here's the most important point I want to make today. This increase in bond yields is going to affect all of us. First of all, it affects the cost of borrowing by the government. So the government's debt financing, the cost of that is increasing. And that means more tax revenue will be needed to finance the interest on the national debt. And the national debt is now heading towards 100% of GDP. So the cost of that is increasing. You know, a lot of the debt that the government raises is index linked to inflation. So it's not surprising, therefore, that the debt financing is increasing as well. I said a few months ago that the 10-year bond yields represent the cost of capital and the benchmark for the cost of capital for all of us. And that means, therefore, corporate borrowing costs will be going up. You know, if I'm going to lend money to you or the government, well, I need to be compensated for that. If the government's going to guarantee to pay me back and I want to lend a corporate money, then I need at least what the government's going to pay me and maybe a bit more. So the bond yields are a benchmark. But perhaps most importantly for individuals is the implication for fixed rate mortgages. Something like 80% of all mortgages in the UK are fixed rate mortgages. About 2 million people are on variable rate mortgages, which are already rising, linked to the base rate. But 80% are linked essentially to bond yields. And if anybody a year ago had maximized their fixed rate mortgage, I hope you took out a 5-year fixed rate mortgage. But the problem will be in 4 years' time. In other words, a year has passed. In 4 years' time, when you come to remortgage, if these yields are still as high as they are today, then obviously there's going to be a significant increase in mortgage repayments for many, many millions of people. That is a concern, obviously. But it all depends on what happens between now and when you remortgage. And that's linked to inflation, and that's linked to risk. It's linked to the war in Ukraine, etc., etc. So a really important graph. But you can all check these figures, by the way, immediately yourselves by going on to a website called Trading Economics. And if you go into markets, you'll see immediately the figures in real time. I've talked about bond yields, which is linked to government borrowing. Now let's come to monetary policy which has been talked a lot about recently. On the positive side, we should thank the Bank of England for the support they gave to the economy in helping it to recover post-COVID. You will all remember the incredible expansion of the money supply as a result of quantitative easing. And quantitative easing caused bond yields to go down. Remember, QE, the consequence of QE was to push up bond prices, which pushes down bond yields. So we all benefited from low cost of borrowing. The government benefited, corporates benefited, and of course, mortgage borrowers benefited. And we also had record low short-term interest rate base rates. So long-term interest rates were pushed down and short-term interest rates went to the lowest ever in our history, in 300 years of our Bank of England history. But we all know what is now happening. And it's not just in the UK, it's across the world. We've had 6 rises in the last 8 months, and there is more to come. There was due to be one this week, but the Bank of England has delayed the meeting of the MPC until the 22nd of September because of the passing of the Queen. But interest rates have gone up from 0.5% to 1.75% on the 4th of August. That was the last rise, the highest since December 2008. Now, 1.75%, yes, it's high compared to 0.5, but it's not that high. Now, the big question is, how high will interest rates go before they reach a peak? A lot of analysts are trying to predict this. The general consensus seems to be somewhere between 4 and 4.5% is likely to be the peak rate of interest rates in the next year. Now, whether that happens or not, I can't be certain, because so much depends on what happens to inflation. And of course, that's linked to the war in Ukraine. If the war continues, for the next year or more, and I hope it doesn't, and if inflationary pressures don't ease, if they increase, then of course all bets are off. But at the moment, the consensus view is base rates of between 4 and 4.5% will be the peak. So I'll leave it at that for the moment. Of course, Bank of England is really between a rock and a hard place. They have got a very difficult job to achieve in terms of the balance between inflation and recovery. They know that inflation is going to rise further. They know that. The forward figures indicate that very clearly. The underlying core inflation is showing a rise despite the small fall yesterday. But that was because of petrol prices coming off the boil. Other parts of inflation are showing a significant rise. And so they know inflation is going to go up, and therefore they are going to raise interest rates. But they know in doing that, they're going to slow down economic recovery. So they've got a really difficult balancing act. We've now got the highest inflation for 40 years. Not a bit less than my professional career so far, but as long as any of us can remember, of course. As I said already, the Ukraine crisis could make things even worse if this situation continues. But that's just a quick picture of the policy. I think it's important just to appreciate what's causing inflation today. And the reason why I want to say this is because the Bank of England has got a difficult job to do because there are multiple causes of inflation. It's like having one rifle bullet, but you've got 5 targets. It's very hard to control all of these causes simultaneously. And that's the difficulty we're facing. Part of the inflation today is caused by the continuation of supply chain bottlenecks. And we're still seeing that in many sectors. There still are problems of getting back to normality. It's a consequence of the pandemic, both during it and since the pandemic, post-pandemic. Microchips, for example. So production of new cars is a real challenge for many businesses and supply chains around the world. We also have seen a shift in demand towards goods, these services. We still buy services, of course we do, but there's been a significant uptick in the demand for goods. So, for example, secondhand car sales. So it's hard to get a new car quickly. And so it's been a big rush for demand for second-hand cars. And we know what's happened to the prices of those. And it's not just in the UK. This is a global phenomenon. But that shift in demand has therefore caused a rise in inflation generally, and it's a contribution. The third element, again, we had a massive fiscal stimulus during the pandemic, and there's still an overhang from that. The amount of money at the governments around the world, and in the UK especially, the amount that was pumped into the economy stimulated demand, and thank you for that, government. At the same time, you may remember, and I'm going to mention it again later, many of us couldn't spend as much money as we would like to have spent. We're holding on to our precautionary savings. We weren't able to go to restaurants during the pandemic, and we couldn't do certain things. So since the lockdowns have ended, there's been a drawdown of household savings. So people have been spending more, thankfully. The government has spent a lot of money. This money is still in the economy, and it's going round and round and round. So the aggregate stimulus is also partly to blame for the inflation. On top of that, and I mentioned it already, labour supply side shock. We've got participation rates, and I mentioned this earlier, are now still lower post-pandemic than they were pre-pandemic. People have made what I've called lifestyle choices. Some people have left the workforce. Some people have retired. Some people have decided, perhaps to go part-time. But this supply side shock has therefore created problems for the supply side, for the jobs, the people that we need to fill the jobs to produce the goods and services. So the growth in the output side of the economy has been curtailed to some extent, and the demand side has been stimulated, and there's the imbalance. And finally, of course, as I've already said a couple of times, we're all facing global supply shocks to energy and food, primarily linked to the Russian invasion of Ukraine. Now, if you're the Bank of England and your job is to control UK inflation at around about 2%, which of these 5 causes are you going to target first? And which ones can you target? There's not much the Bank of England can do about number 5, the global supply side shocks. There isn't much they can do about labour supply side shock. They can do something about shifting demand towards goods and the aggregate stimulus. In other words, interest rate policy today is primarily targeting number 2 and number 3. But number 1, 4, and 5, well, they're outside of the remit of the ability of the Bank of England. And that's really frustrating for them, because what it means is they've got to squeeze demand more to compensate for the other causes. And that's where we are at this very moment, unfortunately, by the way. Let me show you some graphs to summarize where we are with inflation. Here's the latest figures. I fudged a little bit in that this little dot is actually at 10.1%, but I couldn't redraw it quick enough. So the figure that came out yesterday was 9.9%. So I've just drawn that red line just below the 10% deliberately. But just to highlight where we are relative to the past. The past is the past, by the way. We're nowhere near the 1970s periods. I remember when oil prices quadrupled. A barrel of oil quadrupled in 1973, and we had global stagflation, and the UK had significant recession with massive inflationary pressures, even as high as 22, 23, 24%. And we have other crises. The early 1990s recession, you may remember that. Again, having said that, inflation is now back above where it was then. Inflation today at 9.9% is the highest since 1982. So it's quite a long way. It's a 40-year high, as I said earlier, by the way. And so you'll see inflation, was tracking down. We've had a pretty good period from around about 92 to 2002, with some exceptions. But this is now significant at 9.9%. Where's it going to end? Well, it's going to keep on rising. I know it fell slightly because of petrol prices, but I said earlier, if you go online, you will notice that core inflation is still rising strongly, particularly food prices, by the way. And of course, we're going to hear about energy prices soon as well. Really important point here. The Institute of Fiscal Studies produced this bit of analysis a week or so ago, and I think it's very important. But I need to stress that everything you see here is before the government support package kicks in next month. So this is based on today's estimates. It's the prediction for October 22, but that will now be revised. But the key point that's being made here is this, that without the government support package that's going to come in October, without that, the poorest people, and this shows you the bottom line with the income quintiles, broken down to 20%, 20%, 20. So the lowest 20, then the next one is the middle 20, then the third one is the next 20%, and so on. You can work that out quite easily. And what it's showing is very clear. Because the poorest people spend a larger share of their incomes on food and energy, so for them, inflation for them is much higher than the national figure of 9.1%. For them, inflation is almost double what it is for the average. The lowest inflation rate is among the richest. Remember, food and energy as a percentage of what they buy. And so for them, it's 10.9%. Really important. And that's projected, by the way, for October. I just hope the government measures, in my opinion, I hope they target the lower end of the income scale much more than what they intend to do. But I think that they've only begun really to try and tackle this. There's more to say. All of us know, I think, in the UK context, the importance of housing. It is a huge sector. It almost determines the mood of the country in some ways. And I've just pulled off the website in the last day or two, the latest figures, and I've created a very detailed picture here just to give you a quick summary of house prices. I've chosen Nationwide Building Society. I could have chosen Halifax. I could have chosen the Land Registry. Land Registry figures are a little bit higher in terms of average prices, but the picture is very, very similar. So first of all, the top left-hand corner, what this shows is the annual percentage change in UK house prices. And you'll notice, by the way, that it shows that the inflation rate is off the boil, although the Land Registry figures show there's still quite a lot of activity. And even this graph still shows inflation of well over 8%, looks like 8 or 9%. So while it's off the boil, the market is still, showing signs of significant price rises. The rate of increase is what we're seeing here coming down. The 3 months on the previous 3 months, as the shorter term movements, again, shows the inflation rate coming down. But the graphs on the right are really worth looking at closely. The top right-hand corner shows the average UK house price. Now, averages are always, simplicity, but nevertheless, I think the picture is very clear. We now have average UK house prices across the UK, the highest in our history. We have never had averages of this ilk. I think the Land Registry is reporting an average of about 292,000 as of yesterday. So, but they're in the same ballpark figure. Really remarkable. And if you go down to the bottom right-hand corner, that's the important thing to look at. Affordability is estimated on the basis of average house price to average earnings. And what is the multiple? And you'll notice very quickly that the ratio of house price to earnings, if you look very carefully, is now at a record high. I can remember going back in time when the ratio was, even down here, 1992. I remember thinking then, oh, we're in trouble. We're gonna see a big fall in prices, and we did see a fall in prices. But it didn't last very long. And if you look here, the ratio went up, and then we had the financial crisis, and it fell again as house prices fell. But since then, since the financial crisis, we've seen this almost constant rise in the house price to earnings ratio. So that leaves me with a question, and I'll leave it hanging in the air. Is a correction to house prices likely? Now, I'm not going to sit here today and predict a house price crash. I do not think there will be a house price crash. I think there will be a house price correction. And what I mean by that is, I think we're going to see a slowdown in house price inflation. The reason why I don't predict a crash is simply because there's such a huge demand for property. We still have a housing shortage, despite all of the new houses being built. There still is a problem with the housing quality. The existing stock of houses needs a massive amount of investment. And many people, of course, are moving into new properties because it solves the quality problem for them. You may argue about the quality of new property. That's not my intention today, by the way. But if you think of some of the, particularly in the less affluent parts of the country, and that's right across the UK, the quality of housing could be much better. So I think demand for housing is going to remain very strong. I hope the fixed rate mortgages don't become crippling, and I say that very carefully. But I think a correction is inevitable because of the affordability that is highlighted in the bottom right-hand corner. A lot of detail there, folks, and you can check all of this very easily. I've given all the sources on all the graphs as well. Now, in every country of the world, the consumer is king, and I've highlighted earlier the importance of the savings that we built up during the pandemic and how that has carried us through and helped recovery post-pandemic. But I don't think I'm exaggerating to say that the consumer is facing a couple of big crises at the moment. This is on the news almost every day, although not at the moment, thank goodness. We have seen an uplift in consumer spending, which I've just said a moment ago, helped post-COVID recovery. The Bank of England estimates that we saved something like an extra £200 billion during the pandemic by not being able to go to restaurants and cinemas on holidays, etc., etc., etc. And some of that, has been spent and is being spent as we try to return to normal. This is what economists call a multiplier effect. Anything you spend is not spent once. Somebody else receives it and they then spend it. It goes round the economy multiple times and stimulates economic activity. But we now have, as we know very well, a cost of living crisis for many millions of people. And on top of that, an energy price crisis. Now, the energy price guarantee announced by the government last week, remember what it's going to mean. Average household bill. I hate this word average, but it's what's being used to demonstrate the impact of this policy. Average energy bills are going to be capped at £2,500. That's still a big increase from where they were, of course. And there's going to be a 6-month support for business, but we don't know the exact details yet. To be announced, by the way. They've been slow to announce that because of the death of the Queen. The estimate is that this energy price guarantee, when it comes into play, it will take about 4 to 6 percentage points. That's quite a big drop, by the way, of headline inflation. But I'll repeat what I said earlier. It's a bit like petrol prices falling. It doesn't solve the underlying core inflation. It doesn't solve the inflation of food prices. It doesn't solve the labor supply shortages, but it does take inflation rate down, as a one-off fall. What happens after that is what we're all looking at very, very carefully. And the Bank of England, of course, welcomes this move, but they do express concern about inflation thereafter continuing to rise. And not surprisingly, consumers, and we're all consumers, by the way, I'm certainly one of them, we're very worried, some more than others, of course. And it's the point I've just made. Homegrown inflationary pressures are going to pick up. Homegrown in terms of wage demands, homegrown in terms of food prices, and many other aspects. And the BBC's got a wonderful list yesterday of all the different items that are rising in price. And some of the core food items have risen by as much as 30 or 40% over the last 12 months. There's a very long list. It's 6 pages, actually. You can check that if you wish. Food price inflation in August, just reported in the last day or two, is now the highest since 1995 for 37 years. Remarkable. On top of that, remember, and I put this in red at the top of this diagram, before we factor in the government's energy price guarantee, because that hasn't happened yet. If the energy price guarantee didn't happen, What this graph shows you, it shows you that the properties which are the least efficient in terms of energy rating, they're going to have the biggest increase, not surprisingly, in energy costs. The Nationwide Building Society has produced this just recently using ONS data. I think it's incredibly interesting. Again, the point I've just made is the least efficient properties, those in category F and G on the energy rating scale, they're going to have the biggest increase in energy costs. Now, again, the government's policy is going to create a cap, but it's going to be a cap across the board. So it's still the case that those people with the least efficient properties will still have the biggest challenge this winter. And I hope there's more help for those people, because the people in the least efficient properties tend to be at the lower end of the income scales as well. So it's a double whammy for them. Growth for Knowledge, GFK, is a very useful organization to follow, by the way, and I look at their reports regularly. I've chosen their June 22 figures, and I'm going to show you their figures as of last week. But in June 22, they produced this very interesting graph, which measures consumer confidence. You'll notice, by the way, we've had shocks back in the 73, 74 period because of the oil shocks. We had the 80s recession and boom and the fall in confidence. We had interest rates hitting 15%. You'll see that in 1990. We had the ERM crisis in 1992, which, again, I remember it very well. We then had the Northern Rock crisis. You see a big fall in consumer confidence. We then had the UK vote to leave the EU, and there was a fall in confidence there. And then we had the COVID pandemic, a big drop there. But now the cost of living crisis has meant that consumer confidence is now at the lowest it's been for at least half a century. They do this simply by asking a sample survey of people, what are their views about the future? And, you're either positive or you're negative. And it's a very simple calculation. But it's not surprising, therefore, that, consumer confidence is so low, given the coverage and the information that we're getting about the cost of living problems facing many millions of people. I've then taken their latest data, just came out a few days ago for August 2022. So this is a shorter time period. And I just want to highlight once again, if you look at this where it says low, the right-hand corner, what it's showing you is that in terms of the index figure, the blue, solid blue, has shown a sharp fall in the last few months. The dotted line is the annual moving average, but again, it's also showing a fall. So it smooths out the ups and downs. So the conclusion is still very, very clear. We have got a problem in terms of consumer confidence. I'll repeat what I said earlier. The consumer is king. The consumer drives spending in the economy. It's the biggest proportion of all spending. In this country, the consumer accounts for about 60% of all spending. Government accounts for a lot as well, of course. Now, so let me summarize, and I'm just coming nicely to the time when I was hoping to finish and then give lots of room, lots of time to answer your questions, which I hope you're popping into the Q&A box. And James is going to throw them at me in about 5 minutes. But let me summarize everything that I've said, and you will receive a copy of all of these slides afterwards. And I suspect this is the one slide that probably many of you will refer to later if you want to remind yourself of what I've said. And I would recommend that. First of all, and again, and I want to say this up front, yes, we have challenges, but, I'm an optimist by nature. We're a tremendously important economy in the global context, an economy with tremendous strengths. And so this is not all gloom and doom. When I say a slower trend growth rate, that's not necessarily bad news. I think that was inevitable for an economy of our maturity, of our size. We can't keep running faster and faster and faster. We're not an emerging market. So I think that's just the reality. And I've been saying this for the last few years, and I'm not disappointed by it, but it does have implications, of course, for government tax revenues. Because if the economy grows more slowly on a trend, then tax revenues will not grow as quickly as they would like to do the things we need to do. The Bank of England is predicting, and I think most economists are, but not all, they're predicting a mild recession towards the end of this year, which will last for more than a year. But the word mild is the key point there. We're going to bounce around the 0 and the -1% for perhaps 15 months. But the fact is, it could be much worse, and we don't expect it to be much worse. So we've got to get through this period for the next 12 to 15 months, and we've got to keep investing, please, in the future, because there will be opportunities that will emerge after we come out of this crisis. A crisis which is, to a large extent been caused by events elsewhere, and let's hope those events are reversed as soon as possible. We have, and again, I want to celebrate this, historically low unemployment. It's remarkable. But of course, I did mention it has caused labour shortages in many sectors, particularly in retailing and restaurants, etc., including universities, by the way. It's hard to recruit at the moment. We've also got almost record high job vacancies, not quite, but almost at the record high. So if anybody wants a job, they should be able to find a job, but, and I need to put in a big but here, but of course, some of the jobs may not be in the regions where people are living. And some of the jobs may require skills that people don't have. So there may be a mismatch of skills and location. So it doesn't necessarily equate one for one, obviously. We are at the moment seeing real wage stagnation, but wage demands are picking up. And we're all aware of the number of strikes that have been held recently. Some have been suspended during this period of mourning. But no doubt this will be rekindled again in terms of wage demands in the next week or so. And let's see where they end up. We have got a productivity problem in this country. That's official. The government is well aware of it. They're very conscious of it, which is the reason why they're very keen to see a lot more investment in infrastructure, in skills, in energy, in high-speed rail. But these will take time. And in the meantime, we've got some very big regional disparities as well. So it's not going to change overnight. We've also had low business investment, I mentioned earlier. Post-Brexit impact, question mark. You may disagree. I leave it as a question mark, but the official data is very clear. We have had a very, very poor level of business investment since we had the Brexit referendum. You can look for cause and effect at another time, perhaps. We have got an inflationary problem, despite the fact there's a little drop yesterday. But the reality is the underlying inflation is still strong and growing. And the international causes, hopefully are going to diminish. But the domestic causes are still there and picking up, as I've said already. I mentioned already that the national debt is heading towards 100% of GDP, and it will get bigger because the government will have to borrow a lot of money to fund the energy price guarantee that I mentioned. Some are estimating an extra borrowing of about £150 billion. And this national debt will have to be paid back over many decades, not by you and me, but by our children and our grandchildren. It's going to take a very long time to get this scale of borrowing back to anything that seems normal. Now, what is normal? I've almost forgotten. But a debt ratio of about 40% of GDP is what we used to have, and it will take a very long time to get back to that. And of course, the bond yields have gone up sharply. I hope they don't go up much further, but I'm watching it literally on a daily basis. Remember, the bond yields reflect the capital markets' perception of risk in lending to the UK government. And that risk is a function of inflation and a function of the state of the economy. Rising short-term interest rates by the Bank of England, there's no sign of those halting yet. They're currently 1.7%, 1.75%, likely to go perhaps as high as 4 to 4.5%, which is, the case in many other countries as well. Soaring house prices, while inflation of house prices may be moderating slightly, house prices are still rising, and that's putting pressure on affordability, and that pressure will increase as people come to remortgage again. And of course, the cost of living crisis that I mentioned several times is here and now, and it's not going to diminish any day soon. The last point I made was the record low consumer confidence, and the consumer is king. So just to try and finish off literally in 5 minutes, and that will leave us plenty of time. There are major challenges ahead, but I'm going to balance these with major opportunities as well. So hang on for a few moments. Don't be too negative. I think there's a lot of positive things as well to talk about. In terms of challenges, there are no big surprises here, really. We have got an NHS and social care cost challenge. Again, that's not going to go away, but it's one that we're all very familiar with. The aging population, the NHS backlogs, we've got to deal with this. And I'm sure we all want that to have a much better future for all of us, by the way. The cost of living crisis, as I said, it isn't going to go away immediately, but it's certainly going to be a problem for the next year or two for many, many people. And I suspect longer than that. But let's hope the government steps in and does even more, helps even more people. Productivity. All of you listening today, please focus on this in all of your businesses. How can you increase productivity? But it's only through productivity that we can pay workers more. More output per person, per hour, will raise our living standards. And we've got to really focus on that day in, day out. I make that plea, and I hope the government continues to focus on that as well. We have to do that. Investment is the engine of growth. The levelling up agenda, it feels like it hasn't even begun yet, and it hasn't begun yet. There's a long, long way to go. Of course, the government has an election coming up in 2 years' time, and they'll want to be seen to be doing the right thing in terms of levelling up, as well as these other challenges, by the way. And of course, we've got to get back to normal relationship with the EU. Let's hope that the new Prime Minister forges relationships with the EU that enable us to move forward in a positive way in terms of our deal with the post-Brexit deal. And then, of course, and there are many more challenges, and this is a positive as well as a challenge. We've got to continue to forge international trade and investment deals. This has to be the future of the UK, international trade, because it's so important to our economy post Brexit, post leaving the EU. Now, let me try and counterbalance what I said today with some obvious, I think, major opportunities. As you're all listening, I'd like each one of you to think about your own businesses, and you will have ideas, you will have information, you'll have knowledge about opportunities that are already emerging. So, for example, let me make the point very clear. Today, sterling is at a 35-year low against the US dollar. Let's just keep that to the forefront. This is the lowest value of sterling since 1985. But that creates opportunities. In particular, any company that's an exporting company, certainly to the US and to Europe, by the way, and any other parts of the world, if you're not seeing an increase in your exports today, given this exchange rate, then you've got a problem. I mean, I'm assuming you are seeing an increase in your export. I hope you are, I should say, because sterling is so competitive. So this is the time now to drive those export markets very, very hard. Anybody that's operating in the UK tourist industry, tourists in the UK, people coming to the UK for a holiday, it is very, very attractive because of sterling's value. And we are a fantastic tourist economy, and not just London. Of course, there are other parts of the UK as well. So I think we're going to see a significant increase in tourism this summer, for example, sadly on the back of what has happened in the last few days. But, sterling is going to be a massive help to us all. And of course, because of the value of sterling, I expect to see a significant upturn in inward corporate investment. Companies looking to invest in the UK, there probably has never been a better time to invest, given the exchange rate and given the investment that the government is trying to push into the economy to create a more productive economy. But it will take time. It will take time. I think property investment will be very attractive for overseas buyers. Again, a 37-year low for sterling. It's in the last year alone, it's 14% lower. So those sterling assets are cheaper to a foreign investor just because of the value of sterling. And nevertheless, there are many other reasons to buy property, of course, in the UK, as we well know. And I just want to emphasize this point. We've come out of the COVID, and here we are today as a reflection of this. We have all seen an incredible acceleration in our digital skills set. And that has spurred a lot of businesses forward in terms of their reach, in terms of their marketing messages, in terms of their customer relationships. And of course, there are many new businesses being formed as well. So I can say this about Cranfield. We're driving forward with digital education as well, and it's incredibly positive. So I think all of us have shown tremendous innovation and resilience during and after COVID. And I think that the current economic situation is also going to stimulate a lot of innovation and resilience, and will demonstrate resilience. So I've got a very positive outlook, I think, for the future, but I'm also realistic as well. And so let me finish just simply by concluding. And I'm going to use a slide I used last time, but I've added a couple of words. The Institute of Fiscal Studies, they get the credit for the words in red. You'll see the bit that I've added. In conclusion, adjustment to post-COVID, post-Brexit, and now post-Ukraine war new normal will have economic costs that last into the long term. Now, the cost implies negative, and that is the reality. But I think all of us today have to then look at the positives and look for the opportunities. That's my message to you today. I'm going to stop here now and give us plenty of time to address some of your questions. I want to thank you, by the way, for being very patient. I'm going to stop sharing, and it enables me then to see James. There he is, and here I am. And James, I hope there are some questions. Thank you very much indeed.
Thank you, Joe. Indeed, fascinating as always, and indeed it's good to end on a positive note with the opportunities that these challenges present us. Yes, we have got questions. They're coming, most of them quite recently. I'll just start at the top. You alluded to the demand shift towards goods versus services. Would you please comment on what this could mean for the professional services sector?
Yeah, I thought that might come up as a question, and I tried to sort of anticipate it when I mentioned it. I'm not suggesting a fall in services. So let's be very clear. This has been a short-term boost in demand for goods because we didn't go and buy cars. We didn't go out and buy fridges. We didn't go. So this is purely a short-term boost in demand for goods, but not, I mean, to some extent at the expense of service, to some extent. But I think services and professional services are going to remain a very strong part of the economy. So there's nothing negative in what I was implying there whatsoever. So thank you for the question. But Abbas, relax. Services are going to boom, I think, in this country, especially following this morning's announcement, by the way, that the Chancellor is expecting to cancel the limit on bonuses for bankers, by the way. So I think we're going to, he's hoping to boost financial services, and I think that'll have a knock-on effect in other sectors of services as well. So I think it's looking positive.
Thank you, Joe. Next one. How would all these crises fit in with the government's net zero agenda?
Oh, a really good point. And I've had that question recently, and I'm concerned about that. I think that I don't know the answer yet that the government will give us, but I think there is a possibility that they may postpone some of the net zero initiatives for obvious reasons. We need to get more energy, and of course that will mean fracking probably. Who knows what happens to coal mining, more oil and gas. So I really do share the implied concern here, and I think it is a problem for the future, which is why I hope that the crisis ends as soon as possible. And as soon as we get back to the net zero, I mean, they haven't cancelled net zero because they've really said very little about what they're going to do at the moment. I think the next week or two we'll get more information about that.
Thank you. Next one. Is a mild recession really a mild recession where we have lost 2 years of growth already?
Yeah, very good. Yeah, well spotted, by the way. I'm sure. Well, look. I think we've come out of this as good as we could possibly have imagined. So I think I am grateful to the government for what they did during the pandemic. I think we all should be grateful for that. And of course, we have got a debt problem now for the future. But looking ahead rather than looking backwards, I think many more countries in the world are going to be in a far worse position than we are, because they don't have the same deep pockets that our government has, that the country has. So a mild recession, is probably going to feel tough for some sectors. But the reason why I said mild, I haven't used the word stagflation. Stagflation back in the 70s was a deep fall in economic activity with rapid inflation. I don't see that happening. We have got high inflation, but I think the fall in output is going to be mild at worst. Now, let me just qualify what I've just said. In giving forecasts, there is no guarantee that any of these are going to happen. In fact, we hope they won't happen. We hope that by predicting a mild recession, the government will do more to avoid a mild recession. So, this is actually, context. I think the government now will be looking very hard at this information and deciding what they're going to do next. So let's hope all these figures are wrong and we go the opposite way. But mild is better than serious, by the way. Let's be clear.
That's interesting what you say about the government doing all they can to avoid a mild recession. And you referred to investment being the engine of growth. And obviously there are various factors where that might attract inward investment into the UK. Being a tax practitioner, I'm obviously interested in what your views on overall taxation are. Levels of overall taxation are high relative to the post-war era. Would you generally support? Well, what do you think the impact, I suppose, of the proposed? We are likely to see tax changes, or rather tax reductions, in the final couple of years of the current government.
Yeah. Well, there's a political angle to this question and to this answer, of course, and I don't want to be political in any shape or form because I'm not a political person. But I think the government is going to try very hard to give the perception that taxes are coming down pre-election. That's pretty obvious. Yeah. But it depends whose taxes they're going to cut. And the reality is the Bank of England is of the view, and I think many economists, including me, are of the view that tax cuts, while they will be welcomed by millions of people and they will stimulate demand and they will help recovery, they will create even more inflation. Now, back to my earlier point, think of the cause of inflation. If we stimulate demand at a time when we've got labour shortages and capacity problems, then by definition, if you're trying to employ more people because you've got more sales in your pipeline, then wages are going to go up further. And so I think that will simply mean lower taxes will help recovery, will help growth, but will mean more inflation and will mean the possibility of even higher interest rates. So there is the counterbalance. And this is Econ 101. This is the classic situation. Exactly the same thing is happening in the USA. The Fed have already anticipated this, and that's why interest rates are going up faster in the USA because of expected high inflation, and the dollar gets stronger and stronger and stronger. So, it is going to be an interesting balance before the next election.
Thank you. Completely separate question. What's your view on the role space will play on the global balance of power of the coming decades?
Space as in outer space?
It looks that way from the question.
Well, I'm not sure I'm qualified to give an answer to that. So let's assume it's outer space. I mean, who knows? I think we're dealing with the very, very long term, beyond my lifetime, really, in terms of the implications of that. But I think it's about a power play. I think the US is now saying we're back. We're a leading space nation. But I think that's more about technology, and the US saying we've returned to our place in the hierarchy. But if you mean space and outer space, I'm afraid that's a bit beyond my grade. If you mean space in terms of capacity, then of course I've already mentioned that.
Thank you. What is the approximate impact of the fall in sterling on inflation?
Oh, well, hard to know exactly because, we trade with many countries and in many different currencies. But I would suggest we're probably seeing inflation of an extra 3 or 4% because of sterling, but very difficult to estimate that exactly. You'd have to look at the basket value, the average value of sterling against all currencies. But there's no doubt that a fall in sterling does increase inflation. It's what's called imported inflation. A barrel of oil in dollars. If the oil price goes up in dollars and sterling falls, then we get a double whammy, and that's what's happened, of course, to the international inflation that we've experienced. But of course, on top of that, we've now got domestic pressures as well.
Thanks. Also on the matter of inflation,
yeah.
Other than raising interest rates, what other measures might the government or Bank of England use?
Well, I don't think the government's going to tackle inflation. Let's make that very clear. Because to tackle inflation, they'd have to raise taxes and or cut government expenditure. And I don't expect that in the next couple of years. So I think the fiscal policy is off the agenda as an anti-inflation policy. And that's, of course, it is the job of the Bank of England to manage inflation. That is their primary remit. Now, they've only got two tools. One is interest rates, and they're using that, as I said already. And the other is to reverse quantitative easing, and of course that has started. They're no longer buying bonds. They're now going to start selling bonds, selling back the bonds they bought. The consequence is, and we are seeing it already, is short-term interest rates going up and long-term bond yields going up. Because when the Bank of England starts selling bonds, bond prices fall and the yield gets higher. That's simply a fact of life. By the way, this is happening in most countries of the world. This is not just a UK issue, but it represents the only way in which the Bank of England can directly try to impact inflation. You may remember the governor a few months ago tried to impact inflation by asking workers, please don't demand big wage rises. Well, I'm afraid what's called moral suasion isn't very effective when it comes to wage demands in the context of rising inflation.
Thank you. Next one, there's quite a few coming in, Joe. I assume you're okay to carry on until half past?
Oh, we're absolutely okay, absolutely.
Right, what are your thoughts on the Russia-China alliance? Will this continue to get stronger in your mind? The person raising the question says they see huge benefits to Russia in this relationship, but what does China get? Obviously oil. Surely trading partnerships, alliances with other economies are more important to China's continued growth.
Yeah, it's a really good question, by the way, and a very difficult one to answer in any sort of credible way. My view is very simply this. I really respect China and the Chinese government. I think they've done a remarkable job for their people. You can argue against that. But if you look at it in a macro sense, in terms of what they've achieved in the last 25, 30 years and what they're currently doing, they really are focusing on China as a growing power across the world. Now, I think the current situation, I think the Chinese strategy to me is very clear. They're trying to play both sides of the fence. They've said almost nothing about the Ukraine war. They're being very, very quiet about that. So, yes, you are correct. I agree with the point you made that they're going to trade more with Russia. They're going to get more oil from Russia. They need energy in China. I think that's all part of the Chinese strategy. At the same time, China has accelerated its investment in many developing countries. And the graphs are very clear on that, by the way. The data is very clear. They're investing heavily into Africa, faster than they were before. And that's because of what's perceived to be the lack of the West's help to Africa and during the pandemic. So China's filling a vacuum. I think the Middle East, I think that China's got they see opportunities there post-Afghanistan war. So I think they're filling the vacuum. But at the same time, we all need China because they produce, relatively low-cost goods where the quality is rising faster and faster. So I think China, as a world player, is set to increase its influence even further. And they will try very, very hard to stay friendly, quote unquote, with everybody on both sides. And I think it's very smart. Remember, the Chinese philosophy is one of long-term planning. They talk about 100-year business plans. They talk about a 100-year egg in a Chinese restaurant, by the way. It's a cliche for they don't react quickly. They take the long-term views. And I think that's what they're doing right now, by the way.
Assuming there's an end to the Ukraine war at some point, Joe, what do you think are likely to be the main short and long-term economic impact?
Yeah, a great question and a very difficult one for me again, because and I thought about this morning before we started. So much depends upon whether or not Russia turns on the gas pipelines. That's the big issue here. Because even if the war ended tomorrow, if Russia kept the gas pipelines turned off, there will still be an energy crisis because Europe relies on that energy. The UK only relies for about 4% of its gas from Russia. It's a very small percentage. But of course, we're affected by world energy prices. And by shutting off the pipeline, Russia has effectively directly pushed up the price of gas. And I don't think that will end immediately, even if the war ends tomorrow. So short term, there will be some benefits. There'll be more renewed optimism. Stock markets will rebound to some extent. A little bit of inflation will diminish. But I think it's going to take quite a while after that before we see other energy supplies, unless, and this is the big question, unless there's a deal done with Russia which says the war has ended. Now let's get back to normal. You need money. We need gas. Let's negotiate. So, and of course, that's usually what happens after a war. In every war around the world, without exception, when wars end, we always see a sharp bounce back as there's rebuilding, reconstruction, new trade deals. So I do expect to see a bounce back, but who knows when that will be.
Okay, thank you. It's the latest one to come in. What are your thoughts on the possible impact of another new COVID surge or new strain during this winter and what we have been discussing?
Well, I have to be honest with you, in literally 1 hour and 10 minutes, I'm getting my seasonal booster jab. So, let's hope we all get our seasonal booster or an extra jab, because the last thing we want is another resurgence of COVID and the consequence of that. It would be a major problem. Two things. One is a new variant pops up, although I'm hoping that we can deal with that by tweaking the existing vaccines, but it's how quick we get those out to people. And the second one, of course, is the severity of the winter. There's two things here that are going to work together, that could work together, that will cause a sharp shock to the economy. Let's just hope that the COVID pandemic is under control. The vaccination program continues to get rolled out as quick as possible to the most vulnerable, and that's what they're doing right now. I'm not saying I'm one of the most vulnerable, but I'm in an age category where I'm eligible, so I get it this morning. And then, of course, we've got to hope that the energy price guarantee helps people to keep their heating on, and I suspect we're going to have more support coming from the government, by the way.
Thank you. I'm just going down the list to see which ones I've missed, because quite a few came in at once. Here's one. You talked about the global economy. There's a growing concern about relations between the US and China, with Taiwan becoming a major part of tensions in the region. Are there concerns about these tensions escalating and the likely impact?
Yes, and it's a topic I've actually talked about for the last 30 years. This will surprise you. Here's your homework, everybody. We talk about Taiwan as strategically important to USA and to China. In terms of why that's the case, I mean, apart from the politics, the fact is Taiwan is the biggest manufacturer of microchips in the world. They represent the market in microchips, so that's critical for all of those cars and fridges and televisions and mobile phones. Absolutely important. But I think, if I may say this politely, I think Taiwan is a side issue. For China, it's a longer term issue. The really big issue, the one to watch out for, is what happens in the South China Seas. Now, you can all Google this. Look up in Google the Spratly Islands. The Spratly Island, Sprately. I think it's spelled that way. That's the big issue. because they are located in the South China Seas. And guess who believes they own them? Think of the phrase South China Seas. China lays claim to these islands. At least 8 other countries also lay claim to some of them, including Japan, by the way, and Indonesia and so on. But these islands are largely untapped. They represent, first of all, something like 60% of world shipping route. Cargo ships go through those islands, but they have unknown oil reserves, untapped. So when you start researching this, you will see that's the real interest. So I think there is going to be at some point a power play here. Taiwan is just an example of this power play. It is worrying. I don't want to talk about what might happen, but I think, when 2 giants stand facing each other, they realize they can hurt each other, and usually they come to an agreement not to fight. So I'm hoping that's the common sense approach.
Thank you. 2 more have come in. Do you think that the government will allow EU workers back into the UK to help fill vacancies?
Wow. No, I don't. I think that would be an admission of something.
Yeah.
I think they're going to have to further relax the immigration controls. The question is, will they lower the salary threshold, which I think is currently £30,000? But £30,000, is way beyond the salary in the care homes, in many retailing jobs. So they're going to have to do something, or else we're going to be having robots serving us in all the shops and the care homes. So I don't think they're going to do that. No. Do I wish they would do it? I better pass on that one.
Yeah, I was speaking to a client yesterday in the care home sector, and he his biggest concern is staffing. It's a major
crippled
issue.
by crippled.
And the care quality commission don't give them any slack.
Absolutely.
I think this might be the last one. Apologies if I missed any.
Okay.
Which industries would you say will be most resilient to inflation?
Oh, well, I mean, first of all, the obvious ones are the export companies.
Yeah.
I mean, I think that, obviously, if you're an importing company, it's the opposite. Your import costs are rising. But if you're exporting, goodness me, you're going to be bouncing back very strongly. I think the most resilient in general are those who've invested most in the skills of their people, and their people are therefore themselves resilient. I think those who invested most in technology, and that simply means you can increase productivity more easily. But if you're still using old computers and you expect your people to be more productive in their machines, that's not good. So I think this is going to be reflected in those companies that have kept their eye on the ball, that have continued to invest in their systems, in their people, in their technology, and have not just stood still and waited for the problems to arise. I think there'll be lots of examples of this. I don't want to mention my university too much, but I think we've been incredibly resilient, and I'm very proud of what we've done. But I'm sure you'll all have examples there of companies that have really bounced back quite well, very strongly from the pandemic, and will do so post this economic crisis at the moment.
Thank you, Joe. At 10:29, shall we call it a day or a morning? I know you've got things to do.
Probably a good time.
So that just leaves me to say thank you to everyone for attending. It was a really great presentation with some fantastic questions. As mentioned earlier, the slide deck is available, and also please use our website to check out future events. So finally, thank you, Joe, once again for a very, very insightful presentation. I know what my homework is for this evening. And thank you all once again, and enjoy the rest of your day. Thank you.
Thank you, James. And thanks, everybody. Nice to meet you all. Take care and stay safe. Bye-bye.